Master your emotions, master your risk smart.
What's up, everybody? Welcome back to RoyalBluFX. In today's video, we're going to talk about the 3 setups that we always look for before taking the entry. If you haven't already, please go ahead and subscribe to the channel because we always leave out good content. It will definitely help out the channel a lot. Also, we're going to do a quick little review over the 2 trades that we took this last Friday. We want to show you how we were looking at those trades and those setups. That will also show you and guide you in sort of the direction that we are showing you and how we look for our setups. So let's get on with this video. All right, so here we are on our first diagram right here. This is one of the 3. This is considered the liquidity sweep, a swing high sweep. Okay, so most of you guys, I'm pretty sure, are aware that everything in the market is liquidity, including the swing highs and the swing lows. It's not just your relative highs and your relative lows, or your double tops, double bottoms, or ranges. It's not just consolidation periods or whatever like that. That is just liquidity, but it's also swing highs. And I take these to heart because a lot of times when traders are trying to trade supply and demand for this in this matter, right? Let's just say here's your supply zone like this, right? People wait for prices to come to the supply to then when they enter, price manipulates, runs the other way, right? Takes out the high and then runs the low like this, right? Runs the opposite way. So essentially, this is very self-explainable. What you're looking for is a swing high, right, or a swing low. And the reason for that is because these are areas that the market always tends to run because there is drawn on liquidity up there, right? A lot of people, a lot of orders, especially right here, when people have bought. Let me just mark this out actually right over here and explain why this is a swing high. It's a swing high because this impulse here, you can see, ran the high, swept liquidity, right? And then it ran impulsively bearish. So that is considered a swing high, which starts, it begins as our first swing high of the range, right? And then the low starts here. Now, why is this a swing low? Because the swing low broke this internal high in here. So therefore, we have a range confirmed, right? Anyway, so this is a swing high. It swept that swing high, and the markets started to run bearish. This is one of our one of the main entries that we look for. Excuse me, not entries, setups. The entry criteria can all differ when price runs bearish. But this is very powerful, again, like I said, because this is typical that a lot of traders are trapped up here at the swing high area. You got price running out of the swing, this internal swing high, right? And people are buying out, breakout traders, right? Then you have your break and retest traders right here who are also trapped, right? Who are also trying to buy off of this area, break and retest, and then price runs the other way. Now all these traders are trapped. They're negative. Price comes back, right? Eventually, when prices are dropping, all the traders up here will see that. All the positions are negative. They will have to be be forced and obligated to get out of the market once price drops. Then price comes back, right? Takes everybody out, or takes out the other swing high traders here that were selling eventually, right? To then trap more traders right up here, right? To then continue bearish. So this is how we see this market all the time. Now we'll talk about the entry criteria probably on another video from now, but I just want you guys to understand the setup, how this setup works. Now this is just the bearish setup, right? Vice versa, same thing goes for the bullish. You can just literally do this. Let me just get this here, right? You can just do this. The bullish example is the same thing, just kind of like this, right? So it runs the swing high, right? Goes back up, comes back, right? I mean, hold on a second, that's bad. Let me redraw that again. Something like this. Right, then there's your internal swing high, price starts to run like that, then takes out the main swing high, just like this, or excuse me, the main swing low, and goes back in for the impulse like that, right? So we have the internal sweep right there, which confirms this as a swing low here, right? and then we have price coming back and taking out the main swing low right there, just like that, and then price runs the other way, right? So make sure you understand this. This is very powerful, and you'll see you can take this to your advantage and trade, you know, and enter. You can see that these are the most impulsive moves because this is where price runs impulsively. All right, let's go to the next diagram. So here, this kind of follows the one above. We have the swing high swept in here. So what you're trying to do here is mainly look at the swing highs and the swing lows. Swing highs and swing lows confirm the ranges. There are a lot of times when prices are negative up here, like I said, right at the far left over here. Okay, people are trapped. A lot of traders are trapped, so prices come back to mitigate those positions to then for prices to drop. Okay, again, the entry criteria can differ here. We're just talking about the setup and why it's so powerful. Mainly between a swing high and a swing low, a lot of traders are trying to trade inside between the high and the low. So a lot of traders get trapped in here as well, where you see something, you know, like more internal liquidity in here, right? So that's why we avoid trading the you know, the middle, and we just pay attention to the swing highs and swing lows, because that's where most of the market, a lot of the times the markets come to the swing high, to the swing highs or the swing lows. So when you see this 50% EQ in here, you can see that a lot of manipulation can occur, right? When we have internal structure broken, people are trying to sell, then then the markets go up, something like this, right? But at the end of the day, the main objective for each of the trades, or for the setups, let's just say for each of the setups, is to have the market to get to the swing high, right? That's the main objective. At least that's what we teach here at RoyalBluFX. You know, we want the market to get to the supply or to the demand zone. We don't want to, you know, have a half cookie cutter right over here where we think, you know, price is just going to drop just because it went above the 50 EQ, right? This can also be a sweep of the liquidity as well, obviously, but anything can happen in here. The whole point about trading in the 50 EQ is that a lot of times a lot of traders get manipulated in here, right? But anyway, this is a powerful setup you guys should always use. Literally, this is one of the other criteria setups that we use. Just remember, it's a swing high or a swing low, or a swing low and a swing high. It has to sweep liquidity, right? And it has to chalk internally like this. It chalked in here, swing low created, chalk happened, swing high created, all right, because it took out liquidity here, chalk created, right? So then now we have the range confirmed. Let's go to the third diagram. Okay, so this is another very powerful one here. I'm pretty sure a lot of you guys are aware of this one. This is more of a liquidity based, you know, the double tops, triple tops, range liquidity as well. This one's very powerful because you can see here we have a swing high created right over here, and this is why sometimes you know, the markets don't come to your swing highs or swing lows, and this is where we would need to be paying attention to the market to understand, you know, is price ever coming there, and if it's not, what is price trying to do? And that's why you got to really meticulously read the market correctly. So we'd expect price to come there to the swing high right here, and then the swing low is here, right? So you can see that you have a range confirmed, right? You have a swing high and a swing low, because we took out this the internal liquidity, right? Price ran chalked, right? So we have a confirmed low. We have a swing high and a swing low here, excuse me, a swing high because it took out liquidity and it chalked right here. So we do have that confirmed range, and this is where that setup comes into play, where there is a bunch of liquidity sitting like this, right? And there's a fair value gap in here, most likely. Most of the time there is a fair value gap right here. So a lot of traders start trading, you know, they tell you to look at fair value gaps, right? Like that, and you trade away after the liquidity. It mitigates the fair value gap or fills in the price of that gap, right? And then it runs bearish. Now, you know, however you look at this, it doesn't really matter, just as long as you have your eyes trained right and correct. The way we see it, we just look at, you know, the liquidity above the high. Our expectation is once it sweeps the liquidity, it could either come into the supply zone, right? Because we can look at the confirmation here and see if there's manipulation happening. And if there is manipulation happening, we'd most likely want to avoid looking to trade away from the liquidity here, right? But if there isn't, right, and we get our setup or the confirmation in here, right, when prices are switching up, we could look for our chalk boss, whatever, the flips, right, and look to enter and continue price bearish, right? But if it does have some sort of manipulation for the entry type, right, then we can expect for price to get to our supply because it already has swept liquidity, right? But now when we get to this supply, it has to create more liquidity because we just swept this supply, right? This liquidity. So it has to create more liquidity, right? It doesn't have to, but we'd like for it to, right? And then you see liquidity was swept there, right? Price will come back to the supply to only then, right here to the supply, to only then continue bearish like that, right? You can see the liquidity was swept here, liquidity was swept at the lows, right? You get your chalk boss, your internal swing high starts here, internal swing low starts here. Now you have a built-in range, right? And then you can start entering at the swing high as a confirmed, entry to continue bearish, right? Because that is the very point, the very start of the swing high. So this is how you look at this, all right, this diagram. Now, you can definitely look at these in however you want to look at them, right? We're just showing you very simplistic ways how to see them. This is the 3 most powerful ways to see the setups and how to find those impulsive big moves that happen. These are those setups, just like this, right? So right now what I'm going to do is go and take you to a live chart example and show you on the chart how this works. All right, guys, so here we are on a live chart example. So first things first, I'll direct your attention all the way here to the left. We are going to start with our swing low setup, swing low and swing high setups. You can see right over here we have a swing low created, price swept liquidity. As you can see, price ran, right? And then there's your swing high, swept liquidity over there, price dropped, look where it came back to the swing low, right? And from here, this is where the market we would see that would have the intention to push bullish over here, right? So this is where price mitigated, and now we're looking for price to run. Now this is a great setup again because the swing low swept all this liquidity, it ran for some time, right? You can see all this manipulation here. Everyone's trying to buy here, right? Even all here, right? And eventually price comes back to the origin. So swing lows and swing highs are essentially our origin of where price started to move and manipulated everybody, and we need to know where the beginning and end is whenever we're trading, so that way we can find out what the market is trying to do, because most of the times the market comes back to the origin, and because once the move begins, it starts to manipulate everybody, right? And once all the manipulation has been taken, are created, and once all the stop losses have been taken, and everyone has been swept out, the market comes back to the origin to end its manipulation, and then to mitigate its last position right over here, to then decide where should the market go from here. Now, most of the times, 90% of the times, it does continue back in its direction, in the intended direction, which is bullish, because you can see, if you zoom out here, you can see that the markets have been bullish for some time. So a lot of times if you're trading the US US 100, this market is a buying market, right? So we are intending to buy most of the time. So anyway, that's the swing low, that's the swing high. Make sure you understand your ranges, because that's powerful. Okay, let's go right over here. Now, here's another setup, which is another one of our setups that we like. You can see a bunch of liquidities here, right? You can see this is like the trend line, or whatever you want to call it. You have 1 touch, 2 touch, 3 touch, 4 touch almost there. People are trying to buy here, right? Traders are trying to buy here. Prices take them out, right? So what is our intention as the traders here? Well, once the markets have swept everybody, we're looking for prices to run back the other way, right? And that happens with the confirmation that we're looking for, with the another swing low to create most of the time, right? Internal liquidity to be swept. You can see it right over here. that liquidity was swept, which is a swing low created here, right, to another swing high. A chalk has been formed right over here, as you can see, right? And then you have your internal structure, right? And then once the chalk has created in there, and then you can start looking for your setup to go long here, right? Because again, liquidity, the main driver of the market is liquidity, right? So once we find that, right, something like this, it doesn't have to be exactly like this, it can be anything, right? Then we want to look for the confirmation, right, for prices to switch. Now you might think, well, yeah, but isn't there a swing low there? Yes, there is a swing low. It sometimes doesn't, sometimes there is no swing lows. Sometimes price just mitigates or fills in the imbalance, right, just like this, the fair value gap. Let me just kind of draw that out here for you guys, right, something like that. Right, so there's different variations, obviously, to see it because the market is never picture perfect. But once you find out the fair value gap, right, and all the liquidity, expect that this is most likely a liquidity sweep without having a swing low or a swing high involved most of the times. And in this case, this is somewhat of a rare case, but you can see there's a swing low there, swept the low, right? You can see that if I can show you right there. Price ran, created a swing high, chalked, took out all of this liquidity, chalked internally, and here you can see the chalk happened, took out an internal high and a low, price mitigated and ran the other way, right? So you can argue and say that this is also liquidity right here, because it is, right? These are relative highs, or maybe even trend liquidity, right? Trend line, there's 1, 2, 3 touches there, right? So this is a form of manipulation, right? So we trade away from liquidity. If one thing you guys need to know about is always trade away from liquidity. Most likely you can target liquidity as well if there is target that is if there is liquidity given, but essentially you don't necessarily target liquidity. You target either your high or low, but in the essence it does also work that the markets do go towards liquidity a lot of the times, right? Not all the time, but they do, right? Okay, so let's go for another example here. Now here's our other setup example. This is a swing low that is being swept, not just liquidity, but just a swing low. You can see this is a swing low right here. Why is it a swing low? Because it swept liquidity in here. So this is a swing low, right? So a lot of times we'd also wait for the markets to come in here, right? For the potential buy in here, right? So a lot of traders are waiting here for the demand traders, right? These are supply and demand traders. They'd wait for buys right here. What happens? People are the traders are buying here. Let's go zoom in here a bit. Traders are buying here at the demand, right? Price goes up, then it takes them all out, and then price laughs and runs the other way around, right? So this is our other setup, right? That's very powerful because we can't always think, supply and demand. You can't always think one form of way of trading. Now you can, but it's very whenever you're thinking one way of trading, because the market doesn't introduce itself to just one typical way of trading, there's many forms and ways of seeing the market. We need to be flexible to seeing all the types, or at least a few types. That way we can prevent ourselves from actually taking the wrong type of setup, right? So because I am a supply and demand trader, but also mixed in with a lot of liquidity, I have to, the first thing that has to run in my mind is, where's the liquidity? What's the most highly probable thing that the market may do, right? And I always have to think in confirmation. When price gets to a supply or demand or takes out liquidity in any form, swing highs or swing low liquidity, or double tops, double bottoms, triple tops, triple highs, whatever, we always need to think of the confirmation aspect. When price gets to that area, to those areas that I just mentioned, what's the confirmation going to look like, right? We always need to have confirmation in our placed in our mind, in our mindset. So in this case, you can see that anytime price, I'm expecting for price to get to the demand, right? To maybe respect the demand. If it doesn't, then most likely it'll sweep the low, right? And if it sweeps the low, I still have the same directional point of view, that I still want price to go bearish. So it didn't respect the demand, it swept the low, right? My directional bias is still bullish. So it sweeps the low, right? Price closes inside of the liquidity sweep, and then you can either enter aggressive or just wait for more internal confirmation to take price bullish. Just like that. You can see the swing low is here, the swing high is there, right? We took out this low, that means that's a swing low, chalked over here. You can either have an internal chalk or the external chalk. Either way is fine. Swing high, internal chalk in here, you can see internal chalk, right? And then you can also see that it also made the external chalk here and here, right? And then price again runs bullish. It never came back to the swing low to mitigate, right? This, we'd expect this supply to run all the way down here, right? To come and mitigate. Now here's my other setup, the other setup that I really like, because we can see that the markets don't always come to either supply or demands or always sweep liquidity. They don't always do everything all the time. They do it most of the time, right? And we have to expect that the markets aren't just a fixed systematic way that markets always move. They move in wherever and however they want, right? We just have to lightly suggest that the markets can do this, right? They're probabilities, they're not factualities in the market. So here, this is one of our setups, right? Again, we look for liquidity. This is now a liquidity base. It's not a swing low, swing high base. This is where we have a bunch of liquidity again. Here, you can see buyers here, right over here, all this. A bunch of liquidity sitting here. And why do I mark this low? It's because that's where the manipulation started. Buy, right? Price just takes everybody out, right? So I'm expecting this. Once it sweeps, we wait for price to close in again back the opposite way, right? Because we're following the market bullish. So I'm expecting buys here, not sells. So once it does that, right, the swing low is created there, the swing high is created there. You can see that the swing low here swept liquidity. That's the swing low. Swing high is created there. It took out this high, right, and it chalked back the other way. So we chalked here, right, chalked, right. You can look for your confirmation for the entry to continue bullish, or you can look for your confirmation bearish here once it chalks to continue bearish here, right? All the same, you can see that impulsive moves happen right where the liquidity area is, right? From here, you can see how it ran impulsively. From here, you can see how price ran impulsively bearish as well there. Okay, so this is these other juicy setups that we love so much. Okay, let's draw your attention to here to some bearish examples. Right here we have a swing high, took out the high, right? And then here we have a swing low because it took out this low, right? You can see that now the range has confirmed, which means that we're looking for any tradable positions. Now here's what's really interesting. Here is also liquidity right there. Here's where sometimes, because not everything is always perfect, right? Got to understand the intention of the market and where it's coming from. You can see here we have swept liquidity, right? So you might be thinking, yeah, but RoyalBluFX, you just said when you sweep liquidity, you trade away from it. Yes, that's very true. However, you need to have your mindset wide open and seeing, obviously what's happening on the higher time frame. Something like this. You can see a bunch of liquidity swept here. That is a swing low. You draw your attention to the right. Look at this. This intention would tell me that price is coming from a demand zone with a major liquidity swept. So all this data in here would be internal structure, which means we are looking for prices to push bullish into our swing high right there. Now that's also that's the external swing high. This is the internal swing high. So you can see here, if I draw attention here, here's the origin, the swing high there. So then we could put our supply zone right here. All right, now it's that swing high, right? Not this candle, but the swing high. Boom. Price taps it, right? Continues bearish, right? Isn't this amazing, guys? It's really amazing, to say the least, right? We're following our setups, right? We're not trying to be fancy here. We're not trying to take every entry that you see. So this is what we do. This is what we'd be able to see here. We look for the chalk boss, chalk, right? Or earlier on, you can see early chalks from here, chalk, chalk. You can see price takes out that high in there, that candle body high right there, mitigates this wick right there, right? The origin, sells off, right? More manipulation, sweep of the high. Where's that? That's a supply, right? Sell away from it. Takes out the high, mitigates this high here, sell away from it, right? Just like that. Now here's another example here. We took out liquidity, right? Notice that this high here did not go back up to the swing high, to the origin, which would be I would look at this as a swing high in here because that is the next swing high in there. However, we do see liquidity here. There's your 1-2 tap, right? So you do have traders here, right there, right? So you see some liquidity, relative highs there, which means when price sweeps this high, there's no guarantee that price is going to come back to that supply. Sometimes there isn't, right? This is why you have to play sort of the devil's advocate here. You have to kind of think about, oh, price can either come and mitigate the supply or just take out the liquidity and run the other way, right? To which then most traders or some traders could say this could be inducement, right? Because it induced traders from going right up here, right? And it's inducing traders now to sell short fast. Either way counts. Just depends on how you see the market, right? It depends on what the confirmation in here tells us, right? So in this case, since I see liquidity, right, there's no imbalance here, right, but it did take out liquidity and ran the other way. This bearish impulsive candle closed below the liquidity pool, right? That means you could start selling. You start looking to sell short. So this is an also confirmed area for us to look for sells, right? Selling opportunities. This is also a swing high in here, right? So look at this. That's a swing high. Took out liquidity, right? So the swing high was also swept, right? Remember one of my other setups, one of the other diagrams. It takes out a swing high, and it continues the other way, right? That's a swing high to a swing low here. But what's interesting about the swing high is also had liquidity in there, which also helps us to understand, and it's very helpful, that this is a very powerful setup here, right? So we trade away from liquidity. You can see where the impulsiveness happens, right? So that's what I want to show you guys there, right there. I hope you guys understood what I was looking for, and hopefully this video helped you a lot in terms of how I look for the setups and how they're somewhat easy to see, and that's where most of the impulsiveness happens, right? All right, guys, so I'm going to show you the trades that I took this Friday. Just wanted to show you quickly following the video that I showed you, right? I want to show you where I took the trades, and so you guys can see that what I'm saying is fully transparent and real. Okay, so I only took two trades this Friday. I believe it was Friday the 2nd. So it was Friday the 2nd. Go ahead and check me on that. Right over here, I'm going to draw your attention right over here. You can see that we had this area right here. There's one of my trades. Now I'm a scalper, so I take trades on the seconds. Okay. I'm gonna go down to the literally to the 1 second right here and show you what I did. Now I don't always mention that people should always trade the 1 second time frame because it is very fast. You need to make quick decisions, right? We put in high contracts on the seconds literally because we expect for the markets to do what we want them to do, obviously. But in this case, you should never trade the seconds if you don't know what you're doing, obviously. All right, so here we are on the 1 second time frame at the entry that we took this Friday. Now, just mind you, this was very quick. Once price tapped our supply, it took literally seconds, right? So 1, 2, 3, 4, 5, 6, 7, 9, 10, 11, 12. About 12 seconds just to make this, right? Now, let's just go through it, right? So what happened here is, this is one of our entry criterias. You can see here when price swept the high, what is all this? This is really just liquidity, right? There's no swing highs involved. There's just liquidity. That means there's multiple, right? If you go on the 1 second, since we're on the 1 second, you can see there's more here, like there's selling here, they're selling here. But the ones that I saw, the more prominent to me were, I think, on the 30 seconds or the 15 seconds, which were really just this. There's your selling pressure happening here, right? That's your relative highs. But if you extend that down, right, you get that trend line. So what happens is price takes out the high, right, or takes out the liquidity, and then you can see price coming in, right, chalking here. You can see there's your chalk, just right there. And then once you get that chalk, there's your swing high. So we waited for price to get back to the swing high to then sell and trade away from liquidity, right, away from the supply zone. Now, You might be saying, well, why did you do that? Well, look at what happened here on the major structure, on the 1 minute major structure. I call the 1 minute my major structure because I'm always scalping. So you can see the 1 minute here swept the high as well, right? What is this? This is a swing high. It took out this liquidity here, right? Then the swing high was created. I wanted to, I don't even know if I did. I didn't, obviously, if I didn't trade this. But I was looking for my confirmation right here, and price just ran away fast. Now, obviously, there are times when you don't have to look for confirmation, when you just look for a solid body candle closure below the liquidity line, right? And you can just enter there quickly and then just take advantage of this. But because this is the 1 second, it's very quick, it's very fast, right? You can see this is 1 second right here, right? 1, 2, as you can see how fast that is. So I wasn't able to catch this. Then we noticed that we had a sweep of the high right over here. And once we have the sweep of the high, we also look for internal confirmation. This is a bit too early for me, but you can still see that it works right over here. You have a bunch of liquidity, but the swing high is there, or at least the structure, the low starts there. Let me just make that a little bit more clear. Right here you can see that is your low. However, price did sweep the liquidity area, right, just like that. Right, so now we have a chalk to the high and a chalk to the low right here, and then here's your fair value gap right here. You know, you can pretty much look to sell away from here. Now, why would you sell from here? It's because we did take out liquidity. So that's your swing high on the 1 second, right, on a 1 second time frame, right? And then this whole area is pretty much just your entry, right? You can enter here or in the 50 EQ. It doesn't really matter. It just depends on what your rules are, right? But we didn't enter there either, right? So we saw that price move so aggressive, so quick, right? I mean, you got to be quick on these things, right? Because this is where all the money's poured in, right? You want to be on the markets where the market is impulsively running bearish or bullish, and that's where the real money's poured in, right? You don't want to be in these little choppy areas, like say all this stuff, right? You want to be where the money is, right, over here, right? So this is one of the entries that we did, one of the trades. Let me take you to the first one, because this was the second one. All right, guys, so here we are on the first entry that we took. This was on the London session. It pretty much follows the same trade that we did, that we just showed you. But essentially what it's doing here, again, is sweeping the swing high, right? Excuse me. It's sweeping the swing high right here. Why is that a swing high? Because it took out a previous swing high, right? So this is a swing high in here, which becomes liquidity, right? And so my expectation was, well, it could either respect the supply zone, which is this, right? Could either respect the supply zone, because a lot of traders are waiting here to sell from, right? If you take the line chart, look what happened. Prices are respecting that supply zone, right? Because we're, because the market, the body started recording in the supply, not out, because the wick went so fast up above this high, it sold off. But in my case, we waited for prices to close down there, right, just like that. We waited for prices to either, right, this is why I look for confirmation, either it's going to sweep out the high or it's going to respect the supply, and then we're going to look for the confirmation to continue bearish. But once we have liquidity swept like this, prices closed in below the liquidity pool, right, below the liquidity line, and then we just took this market aggressive to target the next swing low, right? Again, it's very impulsive, very bearish, right? It doesn't take time for prices to get to our destination, to the TP. Prices don't do this, just like this, right? Just to get there, right? We are literally in it impulsively, right? That's where the money is, guys. If you understand where the money is, that's where the money is, right? So these were the two trades that we took this Friday, and I hope this shows you guys just an idea of how we take these trades, what setups we look for. And I hope they helped you realize that this is how we trade, and this is how you should trade, because that's where all the money is. Until then, guys, we'll see you in the next video.